stop what you're doing. If you are holding a bank statement, put it down. If you're looking at your 401k, look away. Because as of this Saturday, December 27th, the silver market you knew is dead. The game is over. We warned you that the Shanghai-London spread would eventually snap. We told you the paper ghosts of the comics couldn't haunt the vaults forever. Today, the rubber band didn't just stretch, it vaporized. While New York slept and the Western algorithms were frozen for the weekend, Shanghai just printed a physical price of 83 euros. Look at the screen. That isn't a typo. That is a $5 chasm between the paper lie and the physical truth. The Western banks aren't just sweating. They are in a state of absolute unmitigated panic because the silver they promised to deliver doesn't exist. It is Saturday morning, December 27th. Usually the markets are quiet, but under the surface, the global financial plumbing has just ruptured. The Western spot price is sitting frozen at $78, manipulated by derivative contracts and registered silver that only exists on a ledger. But the Shanghai Gold Exchange, SGE, the only market that actually moves metal, has bypassed all controls. At the close of the session, the benchmark hit the equivalent of $83 per ounce. Do you understand the gravity of a $5 premium? In a functioning world, a bank like JP Morgan would buy silver at $78 in New York, fly it to Shanghai, and sell it for $83 for an instant. Risk-free profit. That's called arbitrage. It's what keeps the world's prices glued together. But today, the arbitrage is broken. The gap is screaming at us. Why isn't anyone closing it? Because there is no metal to move. You can buy the $78 contract in New York all day long, but try to get delivery. Try to load 1,000 bars onto a plane. You can't. The vaults are bone dry. The no silver available sign is not a conspiracy anymore. It is the official policy of the West. This isn't just a war between bankers. It has officially spilled over to your front door. We spent the last 3 hours checking the major bullion dealers. APMEX, 100 O's bars, gone. SD bullion, kilo bars, out of stock. JM bullion, nothing but pre-sale notices with shipping dates in late February. The dealers are selling you metal they hope to get from the refiners. But look at the image on your screen. Look at the smoke rising from Wall Street. This is the vault reveal. The resilient accumulator, the guy who ignored the fear of the dip and the mainstream gaslighting, is the only one with real sovereignty. While the paper class holds a fistful of digital promises, the physical class is watching their wealth migrate east. China didn't just stockpile silver to be mean, they did it for survival. Their solar industry, their tech sector, their military, they realized that if they let silver leave, their future shuts down. They are bidding $83 because they need the metal to keep the lights on. The West is bidding $78 because they are trying to keep a lie alive. As we head into Monday, we are facing a liquidation event. Wall Street sold millions of call options with strike prices at $79 and $80. They thought they could suppress the price forever. But with Shanghai at $83, those options are in the money. The banks are legally obligated to deliver silver they don't have. When the markets open, the algorithms will have no choice. They will have to panic buy futures at any price to cover their naked shorts. It's a feedback loop from hell. Price jumps. 2. Banks panic. 3. Algorithms buy. 4. Price jumps higher. The smasher is gone. The tamp-down team is bankrupt. We are looking at the final transformation of the global economy. If you aren't holding it in your hands, you don't own it. The era of the paper ghost is over. The era of $100 silver has begun. It is early Saturday morning, December 27th, 2025, and while the Western world is still shaking off the remains of Christmas dinner, the global financial order has just been decapitated. Usually, Saturday is the dead zone for price discovery, a time when the sharks on Wall Street and the algorithms at the comics power down for the weekend. But this is not a usual Saturday. This is the day of the great decoupling. While New York spot sits frozen at a manipulated $78 per ounce, the Shanghai Gold Exchange has just delivered a data dump that has sent shockwaves through every central bank on the planet. The number on the screen isn't $78. It isn't $79. It is $83.1 physical. That is a $5 chasm between the paper lie of the West and the physical truth of the East. This isn't just a price spike, it is a financial detonation. The $83 benchmark represents the true value of silver, stripped of the debt-fueled suppression that has kept it in a cage for 40 years. If you look closely at the volume metrics coming out of China this morning, you'll see that this wasn't driven by speculators or retail FOMO. This was an institutional vacuum. The Shanghai physical volume for the morning session exceeded 1,200 tons in a matter of hours. To put that in perspective, That is more silver than many Western vaults claim to hold for their entire registered category. The Chinese solar industry, specifically the manufacturers of N-type TOPCon cells, has moved from buying silver to hoarding it. They aren't bidding for contracts. They are bidding for survival. They looked at their internal inventories, saw the bottom of the barrel, and realized that if they didn't pay $83 now, they wouldn't have a factory to run by January. The $83 print is the sound of the world in S most critical industrial sector outbidding the world S most powerful banks. The Western bankers at JP Morgan and HSBC are staring at these numbers in a state of unmitigated panic because they are trapped in the paper ghost trap. For decades, they have sold 500 ounces of paper silver for every 1 ounce of physical metal that actually exists in their vaults. It was a beautiful game of musical chairs as long as the music was playing. But today, the music stopped. The Shanghai 83 price is a giant neon sign telling every silver holder in the world, the metal is leaving the West. This is the death of arbitrage. In a healthy market, a bank would simply buy silver in New York for $78 and sell it in Shanghai for $83, pocketing a risk-free $5 profit. But they can't. They aren't closing the gap because they can't find the metal to ship. The cheap silver in New York is a myth, a digital hallucination that only exists as long as nobody asks for delivery. The $5 gap is the price of truth. And that truth is that the COMEX is empty. When you analyze the volume, you realize that the West has lost the ability to tamp down the price. In the past, the moment silver got too expensive, the big banks would drop a paper bomb, selling millions of ounces of futures contracts in seconds to trigger stop losses and crush the momentum. But that tactic only works if you have the credibility to back it up. With China bidding $83 and banning exports, the smasher has been disarmed. If a bank tried to sell short today, they would be steamrolled by the massive physical class that is now bypassing the exchanges entirely. We are seeing a historic migration of wealth. The silver is flowing from the vaults of the algorithm bankers into the physical hands of the resilient accumulator. The man you see in the image, looking through those glasses at the chaos on Wall Street, isn't panicking because he understood the signal years ago. He realized that the price on the screen was a gaslighting mechanism designed to keep him in a vault of smoke. This $83 detonation is the inciting incident for a total liquidity collapse. As the news of the Shanghai print spreads through the weekend, the smart money is already moving. They aren't waiting for the COMEX to open on Sunday night. They are cleaning out every retail dealer in the United States. They are buying 1,000-ounce bars, kilos, and even junk silver at premiums that would have seemed insane a month ago. They know that when the markets officially open, the $78 spot price will have to chase the $83 Shanghai price. It is a feedback loop from hell for the shorts. Every dollar the paper price rises, it triggers more margin calls, which forces more buying, which pushes the price higher. It is a vertical line of empty space where the sellers used to be. The 83 price is the true value, because it is the first price in 40 years that is not being suppressed by Western debt instruments. For the last few years, silver has been in a structural deficit of over 140 million ounces annually. The world was eating its seed corn, relying on existing stockpiles to fill the gap. But those stockpiles hit zero this morning. The no silver available sign is now permanent. What we are witnessing is the great decoupling, where the physical reality of the East has finally broken the paper chains of the West. If you are still holding a silver ETF or an unallocated bank account, you are holding a paper ghost. You are holding a promise from a banker who is currently watching his world burn. The $83 Shanghai detonation isn't just a market move. It is the end of an era. The Western banks are no longer the price setters. They are the price takers. And right now, the price of entry into the new global elite is being set in Shanghai, and it is rising by the minute. The financial world has long operated on a single, unwavering law, the law of one price. For decades, the global silver market was kept in a state of artificial equilibrium by the mechanism of arbitrage. If the price in London was a few cents cheaper than the price in New York, traders would pounce, buying the low and selling the high until the gap vanished. This was the glue that held the paper illusion together, a system of high-speed digital trades and occasional physical shipments that ensured the spot price was a universal truth. But as of this Saturday, December 27th, that law has been repealed. The glue has melted. We are now staring into the abyss of a $5 chasm between the Western paper price of $78 and the Eastern of physical reality of 83. This isn't just a market fluctuation. It is the death of arbitrage, the definitive signal that the global physical supply chain has been severed and a wall has been built between the hemispheres. In a normal market, a $5 spread would be a gold mine for bullion banks like JP Morgan or HSBC. At $5 per ounce, you could charter a private Boeing 747, fill it with 1,000-ounce LBMA bars from a London vault, fly it across the Pacific, and still clear a fortune after insurance and fuel costs. So why isn't it happening? Why is the gap sitting there, widening by the hour, screaming at the world that the system is broken? The answer is as simple as it is terrifying. The wall is no longer made of tariffs or trade agreements. It is made of empty space. The banks aren't moving silver to Shanghai because they don't have the silver to move. The eligible and registered categories on the COMEX and the LBMA have become a graveyard of digital entries. When the Chinese industrial giants placed their bids at $83, they weren't asking for paper promises. They were demanding physical delivery into SGE-certified vaults. The Western banks looked into their own vaults, saw the dust on the floor, and realized that for the first time in history, they could not fulfill the arbitrage. This $5 gap is the death cross of the paper silver market. It represents a fundamental loss of confidence in Western price discovery. When the price in Shanghai decouples to this degree, it tells the world that the London and New York tickers are no longer tracking the value of a metal. They are tracking the value of a failing currency. The wall has been further reinforced by a series of quiet emergency measures taken by Western logistics and insurance giants. We have received unconfirmed reports that the major precious metals couriers, the likes of Brinks and Loomis, have suspended new international silver shipments out of Heathrow and JFK. The reason cited is security concerns and logistical renegotiations, but the reality is much bleaker. Insurance underwriters have looked at the $5 spread and realized that any metal currently in transit is effectively unpriceable. If a shipment leaves London valued at $78 and arrives in Shanghai where the market is screaming 83, who bears the risk of that volatility? The system is frozen because the gears of the physical market are jammed with the sand of a shortage. The severance of the supply chain means that the West is now an island of paper ghosts, while the East has become the physical fortress. China has spent the last decade vacuuming up the world's silver supply, not just as an investment, but as a strategic necessity for their dominance in green energy and advanced electronics. They have built a one-way valve. Silver flows in, but it never flows out. This weekend, that valve was locked shut. With the Shanghai $83 print, China has effectively told the world that they will outbid any Western institution for every available ounce on the planet. They aren't just buying silver, they're buying the West's industrial future. The $5 gap is the premium for physical certainty. If you are a manufacturer in Germany or the United States and you need silver for your production line, you can no longer look at the COMEX screen for guidance. That $78 price is a lie. If you want the metal, you have to go where the metal is, and right now, that is the East. At a $5 premium, that resets the entire cost basis of the global economy. This severed connection is why the resilient accumulator in our story is the only one left with options. He didn't rely on the arbitrage class to protect his wealth. He understood that when the system breaks, it breaks at the joints, at the points of connection between the digital and the physical. By holding the metal in his own hands, he has bypassed the wall. He doesn't care that the COMEX is frozen or that Brinks has suspended shipments. His silver is already delivered. He has achieved a state of financial sovereignty that the billion-dollar hedge funds are now scrambling to find, while the bankers in New York are sweating under the fluorescent lights of their risk management desks, trying to figure out how to bridge a gap that cannot be bridged. The physical holder is watching the value of his asset reflect its true unmanipulated utility. The $5 gap is a message to the paper class. Your contracts are not silver. Your ETFs are not silver. Your bank balances are not silver. Only the silver is silver. As we move toward the market open, the implications of this broken arbitrage will become a catastrophe for the short sellers. Thousands of industrial users who previously relied on the just-in-time delivery model of the Western exchanges are realizing that the time has run out. They are seeing the $83 Shanghai price and the $5 gap, and they are panicking. They are calling their brokers, demanding delivery of the silver they thought was sitting in a vault in Delaware or London, but the brokers are giving them excuses. Force majeure is the phrase of the day. The supply chain has snapped and the wall is rising higher. The West is being liquidated in real time. This is the moment the paper ghosts are exorcised from the market, leaving behind a smoking ruin where the only thing that matters is the weight of the metal you can touch. The $83 detonation was the blast. The $5 gap is the fallout that will poison the Western financial system for years to come. Behind the glass-walled offices of the world's most powerful bullion banks, the air conditioning is humming at max capacity, but it isn't enough to stop the cold sweat. The image of the sweating banker is no longer a caricature, It is the living reality of the risk desks at JP Morgan, HSBC, and the other major swap dealers who have spent years shorting silver to protect the stability of the US dollar. On this Saturday morning, as the Shanghai $83 print flashes on their private terminals, the atmosphere is one of clinical terror. These men are the algorithm bankers, the architects of a system built on paper ghosts, and they have just realized that the ghost has finally left the machine. They are staring at a ledger that cannot be balanced, a short position so massive that it threatens not just their bonuses, but their very existence. For decades, these institutions have operated on the assumption that silver is a commodity they could always control through sheer volume. If the price rose, they simply sold more naked paper contracts, promises to deliver metal they didn't have, to overwhelm the buyers and drive the price back down. It was a rinse and repeat cycle that kept the COMEX price suppressed while the banks pocketed the premiums. But today, the reserves depleted status isn't just a conspiracy theory whispered in stacker forms. It is screaming from the official ticker. The COMEX registered inventory, the only silver actually available to be delivered to buyers, has plummeted toward zero. The banks aren't just short, they are naked in a hurricane. They have sold hundreds of millions of ounces into a market that has no more physical metal to give back. Inside the trading floors, the panic is silent but absolute. The 11:01 clock rule, the coordinated dumping of paper silver to smash rallies, has been rendered useless. When the market opens on Sunday night, the algorithms will recognize that the Shanghai price is the new reality. They won't be looking to tamp down the price anymore. They will be looking for the exit. This is the banker flip we warned you about. For years, these banks were net short, betting against silver. But as the physical shortage became undeniable throughout 2025, a few of the smarter desks began quietly trying to hedge their bets. Now, the ones who didn't move fast enough are caught in a gamma squeeze of biblical proportions. They sold call options at strike prices of $70, $75, and $80, thinking those levels were a ceiling. With silver at $83 in Shanghai, those options are in the money. And the banks are legally obligated to find silver that does not exist on this side of the planet. The sweat you see on their faces is the realization that force majeure is their only remaining move. They are preparing the paperwork to tell the world's industrial giants, the solar companies, the tech manufacturers, the defense contractors, that the silver they paid for will not be coming. This is the moment this paper class realizes they have been trading in a one vault of smoke. The banks have been using the same 1 ounce of silver to back 500 ounces of paper claims, a fractional reserve game that works perfectly until everyone asks for their metal at once. Today, everyone is asking. The physical class, led by the resilient accumulator, is watching from the sidelines as the banks begin to devour each other. To cover their short positions, these banks will be forced to go into the open market and buy silver at any price. But who is selling? China has banned exports. Mexico is halting shipments. The local coin shops are empty. The banks are forced to buy from each other, pushing the price higher in a feedback loop from hell. This isn't just a liquidity crisis. It is a total loss of the now moral hazard that allowed these banks to act with impunity for so long. They believed the Federal Reserve would always be there to bail them out, to print more dollars to cover their losses. But dollars can't make solar panels. Dollars can't conduct electricity. You can't build a satellite out of a bank statement. The true value of silver has finally decoupled from the debt-based currency system, and the banks are the last to know that their paper is worthless in a physical world. The smoke rising from Wall Street isn't just metaphorical. It is the burning of the ledger books. Every tick of the clock brings us closer to the moment the registered. Inventory hits absolute zero. When that happens, the COMEX won't just close for the weekend, it will close for good. The banks are currently in a state of unmitigated panic because they have become the very mice in the trap they used to brag about catching. They are trapped by the gravity of the East, pulled toward the $83 magnet in Shanghai, and they have no more pebbles to throw to trigger an avalanche. The smasher has been smashed. As the sun rises on Sunday, these bankers will have to explain to their boards and their governments how the safest short bet in history became an existential threat to the global financial system. They are staring at the reserves depleted notification, knowing that by Monday morning the world will know the truth. The kings of Wall Street have no clothes, and they certainly have no silver. The forensic reality of the global silver market on this Saturday morning is one of total systemic exhaustion. For years, analysts warned of the bleeding vaults of Wall Street, tracking the slow, agonizing drain of physical metal from the COMEX and LBMA warehouses. But as of December 27th, the bleeding has stopped for a much more terrifying reason. There is simply no more blood in the stone. The just registered silver category, the pool of metal that is officially warranted and ready for delivery to satisfy futures contracts, has hit a functional zero. This isn't just a low inventory report or a seasonal dip. This is a no silver available sign permanently etched onto the gates of the Western exchanges. When we talk about Wall Street in flames, we aren't just describing a price spike. We are describing the total incineration of the paper ghost system that has dictated global finance for nearly half a century. To understand the magnitude of this crisis, you have to look at the anatomy of the COMEX vault system. In the world of paper derivatives, there are two types of silver: eligible and registered. Eligible silver is metal that meets the exchange's standards but is owned by private parties, individuals or institutions who are simply using the vault for storage. It isn't for sale. Registered silver, however, is the lifeblood of the exchange. It is the metal that has been pledged for delivery against short positions. For the last 5 years, as industrial demand from solar and AI sectors surged and mining production stagnated, the banks have been raiding the registered category to satisfy the physical class who demanded delivery. This morning, the ticker updated with the final forensic data. The registered category is empty. There is no more metal for the banks to deliver. The vault doors are open, and there's nothing inside but the smell of burnt promises and the desperate sweat of the algorithm bankers. This brings us to the only card the Western exchanges have left to play: force majeure. In the fine print of every silver futures contract is a clause that allows the exchange to suspend its obligations in the event of an act of God or unforeseeable circumstances that make physical delivery impossible. For decades, investors viewed this as boilerplate legal jargon, a break glass in case of emergency measure that would never actually be used. But today, force majeure is the official policy of the West. The exchanges are preparing to tell thousands of contract holders, industrial giants, hedge funds, and sovereign nations that their silver will not be delivered. Instead, they will be offered a cash settlement based on the last suppressed paper price. But who wants a handful of depreciating dollars when the physical reality in Shanghai is $80 and climbing? A cash settlement in a hyperinflating environment isn't a payout, it's a default. The smoke rising from the financial district is the sound of the paper markets collapsing into themselves. When the world realizes that a force majeure event has been triggered, the trust that underpins the entire derivative system vaporizes instantly. If the COMEX can default on silver, why wouldn't they default on gold? Why wouldn't the banks default on your unallocated savings? The resilient accumulator, the man you see in the image holding his physical bars, is the only one who doesn't have to worry about the legal fine print. He's not waiting for a court to decide if an act of God prevents him from accessing his wealth. He is the master of his own vault. While Wall Street burns, his sovereignty is absolute. He realized that the true value of an asset is only found when you remove the counterparty risk, and today that risk has reached its terminal conclusion. The forensic look at the vaults reveals a deeper truth. The silver was never really there in the volumes they claimed. The system relied on the paper ghost illusion. The idea that as long as everyone did not ask for their metal at the same time, the fractional reserve game could continue forever. But the $83 Shanghai detonation was the catalyst that made everyone ask at once. The physical class saw the gap, saw the desperation of the East, and they called the bank's bluff. The result is a total liquidity lock. There is no silver available at 70K. There is no silver available at 80. There is only silver available at the price the physical holder is willing to accept. And right now, that holder is in the East, and they aren't selling. As the Saturday morning sun hits the skyline of New York, the realization is sinking in. The West has lost its most potent weapon of financial suppression. You cannot tamp down a market when you have nothing to sell. You cannot manipulate a price when you have no physical collateral to back your trades. The wall between the paper, lie, and the physical truth has been built, and the Western exchanges are on the wrong side of it. This isn't just a market correction. It is a forensic liquidation of the old world. The vaults are empty, the contracts are being torn up, and the only thing left in the ruins of Wall Street is the smoke of 100 million paper ghosts finally catching fire. While the skyline of Manhattan is metaphorically wreathed in the smoke of burning ledger books and the frantic, silent screams of the paper class, the atmosphere in Shanghai is one of calculated historic triumph. This Saturday morning, as the $83 silver print solidifies on the digital boards of the Shanghai Gold Exchange, we are witnessing the culmination of a decade-long grand strategy. While the West was busy financializing every aspect of its economy, turning real assets into complex derivatives and paper ghosts, the East was playing a much older, much more lethal game. They were vacuuming. For 10 years, under the cover of market apathy and Western manipulation, China has been the world's most aggressive accumulator of physical silver. They didn't just buy the dip, they bought the entire supply chain. And today, as the New York financial district faces a total liquidity collapse, Shanghai is standing on a mountain of metal, presiding over the new era of global price discovery. The contrast could not be more stark. In the West, we have the resilient accumulator, the lone individual from our image, holding his ground amidst the wreckage of a debt-based system. He is the outlier in a society that forgot what real wealth looks like. But in the East, the resilient accumulator is the state itself. China's great stockpile was not an accident of trade. It was a deliberate act of economic warfare. They watched the Western banks use the COMEX and LBMA to suppress prices, and instead of complaining, they thanked them. They used the artificially low prices created by Western shorts to subsidize their own strategic reserves. Every time a tamp down happened in New York, the SGE saw a massive spike in physical delivery. While Wall Street was celebrating a successful price smash, container ships were quietly leaving Western ports, bound for the vaults of the East, laden with the very metal the West was pretending wasn't valuable. This decade of preparation was driven by a fundamental realization that the West ignored. Silver is the indispensable metal of the 21st century. China understood that you cannot have a green revolution, a high-tech military, or a dominant semiconductor industry without silver. They looked at the numbers and saw a structural deficit that the algorithm bankers were trying to hide with paper contracts. They saw that the world was moving toward N-type TOPCon solar cells, which require 30% to 50% more silver than previous generations. They saw the explosion of AI and the massive silver requirements for high-performance computing. And they realized that the country that controlled the silver would control the future of technology. So they spent 10 years vacuuming up global supply, buying mines in South America, securing offtake agreements in Africa, and encouraging their own citizens to stack physical metal. The $83 breakout isn't just a number, it is China's mission accomplished moment. By allowing the price to decouple so violently this Saturday, they have effectively declared that the era of Western price suppression is over. They have built a physical fortress that the Western banks cannot breach. Because China controls the physical inventory, they now dictate the terms of global trade. If a Western manufacturer needs silver to finish a production run of electric vehicles or solar panels, they now have to pay the Shanghai premium. They have to pay $83 while the paper price in New York remains a useless frozen $78. This is the triumph of the physical reality over the digital lie. The East didn't beat the West at the paper game. They simply waited for the paper to burn and made sure they were the ones holding the only thing that does not burn, the metal. As the sweating banker on Wall Street stares at the reserves depleted ticker, the SGE officials are calmly overseeing a market that is functioning exactly as intended. In Shanghai, there is no force majeure. There is no talk of cash settlements. If you have the money, you get the metal because the metal is actually there. China has spent a decade ensuring that their vaults were full before they let the rubber band snap. They watched their registered silver levels on the COMEX drop from 150 million ounces to the functional zero we see today. And they knew exactly where that silver was going. It was going into their strategic solar reserves and their industrial stockpiles. They have effectively cornered the most important industrial metal on Earth, and they did it using the West's own manipulation tactics against them. The triumph of the East is the final validation for the physical class. It proves that in a world of infinite digital printing, the only true sovereignty belongs to those who own the finite. The man in the glasses, watching the smoke rise from the New York exchanges, represents the awakening of the Western individual to the reality that the East has known for years. The $83 detonation was the signal that the wealth of the world has migrated. It has moved from the vaults of smoke in London and New York to the physical vaults of Shanghai. This is the great decoupling in its final form. The supply chain has not just been severed, it has been redirected. The silver is flowing to the highest bidder, and right now, the highest bidder is the one who had the foresight to prepare for a world where paper is worthless and metal is king. The $83 price is the price of admission to the New World Order, and China has already bought all the seats. The terrifying realization hitting the masses this Saturday morning is that the majority of what they believed was silver is actually a paper ghost. As the Shanghai $83 print flashes across the screens of terrified retail investors, the fundamental flaw of the Western financial system is being exposed in a brutal public liquidation. For decades, the mainstream media and financial advisors have funneled the average investor into silver ETFs like SLV or unallocated bank accounts, promising that these digital entries were as good as gold. They sold the convenience of a ticker symbol while hiding the fine print that revealed the truth. For every 1 physical ounce of silver sitting in a vault, there are 500 paper ghosts haunting the market. These are digital claims, synthetic rehypothecations, and unbacked promises that are currently dissolving into thin air as the physical reality of the 83 price tag collides with the digital lie. If you are holding a silver ETF right now, you aren't holding silver. You are holding a tracking error. The prestigious paper ghost liquidation is the process of the world discovering that these funds were never designed to give you the metal. They were designed to keep you away from it. In the prospectuses of these major funds, hidden behind walls of legalese, it clearly states that they can settle in cash or suspend redemptions if extraordinary circumstances arise. This morning, as the "No Silver Available" sign is hung on the doors of the Western exchanges, those extraordinary circumstances have arrived. The holders of these paper ghosts are realizing that they are at the very back of the line. While the physical class and industrial giants are fighting over the last remaining bars, the ETF holders are left clutching a digital receipt for an asset that has already left the building. The ratio of 500 to 1 is the most dangerous number in the financial world today. It represents a massive, unstable pyramid of debt built on a tiny, crumbling foundation of physical metal. This is the vault of smoke, in its most literal sense. Imagine a game of musical chairs where 500 people are dancing around a single chair. As long as the music plays, as long as the paper price is manipulated and the public stays asleep, everyone feels wealthy. But the Shanghai $83 detonation is the sound of the music stopping. When the 500 people rush for that one physical chair, 499 of them are going to hit the floor. This is the liquidation we are witnessing. The unallocated accounts, where you pay a bank to hold down silver for you without actually assigning you specific serial numbers, are the first to be vaporized. In the banking world, unallocated is just a fancy word for unsecured creditor. The bank took your money, used it to bet against the price of silver, and now that the price has exploded, they don't have the metal or the cash to make you whole. The resilient accumulator in our story, the man who ignored the convenience of the ETFs and chose the burden of physical possession, is now watching the greatest transfer of wealth in human history. He is watching the paper class realize that their 401ks and their brokerage accounts are filled with ghosts. When the market opens on Monday, there will be a frantic scramble as ETF holders try to sell their paper to buy physical. But they will find that the physical market has already gapped up beyond their reach. The premium for actual touchable silver will not just be $5. It will be $10, $20, or $50. The paper price will become a tombstone, a static number representing a dead system, while the physical price disappears into the stratosphere. This is the price discovery that the banks feared most the moment the world realizes the paper price was a tool of suppression, not a measure of value. The liquidation of the paper ghosts is a cleansing fire. It is removing the artificial supply that has suppressed silver for 40 years. Every time an investor bought SLV instead of a physical bar, they were inadvertently helping the banks suppress the price. They were providing the liquidity that allowed the shorts to keep the lid on the boiling pot. But the pot has exploded, and the 500 to 1 leverage has become a 500 to 1 liability. As the paper ghosts are liquidated, the short squeeze becomes an everything squeeze. The banks who sold those ghosts are being forced to buy physical silver to try and cover their tracks, but they are competing with the very people they lied to. It is a scene of absolute chaos inside the digital vaults of Wall Street. The ledgers are being reconciled and the math doesn't work. It will never work again. This is why the image of the sweating banker and the vaults in flames is so resonant. The flame is the truth. It is burning away the synthetic, the reapothecated, and the fraudulent. If you're sitting on the sidelines with your physical silver, you aren't just an investor, you are a survivor. You have escaped the paper ghost liquidation that is currently drowning the mainstream financial world. You have realized that in a world of infinite digital printing, the only true hedge is the finite. The $80 price in Shanghai is a beacon of reality in a sea of digital hallucinations. As the weekend progresses, and the news of the "No Silver Available" crisis spreads, the panic will move from the trading desks to the kitchen tables. People will check their accounts, they will read the fine print, and they will realize that the silver they thought they owned was never there. The ghosts are being exorcised, and the only thing left standing will be the physical class, and the metal they hold in their hands. The 500 to 1 ratio is the ultimate indictment of the Western financial system. It proves that the market was never about supply and demand. It was about the management of a lie. But you can't manage a lie once the physical supply chain is severed. You can't manage a lie once China bids $83 for real metal. The liquidation is final, it is total, and it is just beginning. By the time the sun sets on this Saturday, the term paper silver will be synonymous with loss. The era of the ghost is over, and the era of the $100 physical reality is here. As the final hours of this historic Saturday, December 27th, 2025, draw to a close, we are not just looking at a weekend market blip, we are witnessing the birth of a new era. The map for the next 72 hours is already being drawn in the panic rooms of Western central banks and the celebratory boardrooms of the East. When the global markets open Sunday evening in Asia and eventually move through London to the New York bell on Monday, The world will realize that the $83 Shanghai print was not a destination, but a launchpad. We are officially on the road to $100 silver and beyond. The momentum is no longer driven by speculation or chartism. It is driven by the physics of a vacuum. The smasher is broken, the paper ghosts have been exorcised, and there is nothing left to stop the price from seeking its true, unmanipulated utility value in a world that is starving for physical collateral. The next 72 hours will be a blur of limit-up halts and force majeure declarations. When the Globex markets open Sunday night, we project an immediate, violent gap-up as the Western spot price tries to close the $5 chasm with Shanghai. But it won't just stop at $83. The algorithms, sensing the total lack of sell-side liquidity, will begin a vertical moonshot. Every short seller still trapped in the system will be forced into a mandatory liquidation, hitting the buy button at any price just to stop the bleeding. This is the feedback loop from hell in its final terminal phase. By Monday morning, $90 will be in the rearview mirror, and the psychological barrier of $100 will be looming like a mountain over the financial district. The $100 target isn't a meme or a moon boy prediction. It is the mathematical result of 500 to 1 leverage meeting a zero inventory reality. This move to 100 represents the final transformation of the physical class into the new global elite. Look again at the man in the glasses from our image, the resilient accumulator. For years, he was mocked by the mainstream media and the algorithm bankers. He was told that silver was a dead asset, a pet rock that didn't pay a dividend. He was gaslit into believing that his wealth was better spent in a vault of smoke or a high-fee ETF. But as the smoke rises from the New York exchanges and the $100 price flashes on the ticker, he is the only one left with true, unencumbered sovereignty. He is no longer an investor in a system. He is the owner of the system's most critical resource. In the new era, wealth will not be measured by the number of digital zeros in a bank account, but by the weight of the metal you can touch. The physical class has become the sovereign class, while the paper class is left to fight over the scraps of a bankrupt derivative market. The geopolitical implications of the $100 era are staggering. As silver crosses that triple-digit threshold, the great decoupling will be complete. The Western debt-based system, which relied on cheap silver to subsidize its electronics and solar industries, will face an inflationary shockwave that will dismantle its remaining industrial base. Meanwhile, the East, standing on its great stockpile, will dictate the terms of the future. The $100 price is the sound of the world's industrial center of gravity shifting permanently. We are moving into a world where silver is no longer traded as a financial plaything, but as a strategic currency of survival. Every ounce held by the resilient accumulator is now a ticket to the new economy, a shield against the hyperinflationary fire that is currently consuming the fiat currencies of the West. Over the next 3 days, you will see the mainstream media pivot from denial to panic. You will see headlines about market instability and unregulated speculation, but they will never tell you the truth, that the banks were naked and the East was prepared. They will try to blame the silver squeeze on retail traders, but the forensic data shows it was the industrial giants and the sovereign vaults that pulled the trigger. The road to 100 is a one-way street. Once the $83 barrier was broken this Saturday, the psychological floor for silver was reset forever. There is no going back to $30 or $40 silver because the trust required to keep the price that low has been incinerated. The market is now in a physical price discovery phase. And in a world with a 140 million ounce annual deficit and a solar industry that will pay anything to keep the lights on, $100 is just the beginning. As we stand at the edge of this new era, the call to mental fortitude has never been more vital. The silver squeeze is no longer a theory. It is a physical reality that is playing out in the burning streets of the global financial system. The vault reveal has happened, and the world knows the truth. The vaults are empty, the banks are sweating, and the metal is in the hands of those who had the vision to hold it. The next 72 hours will be the most volatile, terrifying, and rewarding time in the history of the precious metals market. The resilient accumulator has crossed the finish line, and the physical class is now in the driver's seat of the global economy. Welcome to the new era. Welcome to the age of triple-digit silver. The game is over, and the truth has won.